Hello learners, today we will continue the Unit 1 which is Introduction to the Financial Management. So the agenda of today will be to understand the difference between the profit maximization and wealth maximization, what are the key decisions of the financial management, what is the role of a finance manager and the sources of finance. Profit maximization. It is believed that the objective of the shareholders is to maximize the profit. So, to achieve this goal of the profit maximization, the financial manager takes only those actions that are expected to increase the overall firm's profit. The total earnings which are available to the firm shareholder is commonly measured in terms of the EPS, which is earning per share. So the decisions and the actions of the financial managers should result in the higher earnings per share for the shareholders. Now, what are the points which are favored in this profit maximization objective? It is a parameter to measure the performance of a business. Also, it ensures maximum welfare of the shareholders, employees, and prompt payment to the creditors. Increase the confidence of the management in expansion and diversification. It also indicates the efficient use of funds for different requirements. Now, the profit which are against the profit maximization, that it is not clear, like accounting profit before tax or after tax or net profit or gross profit. It encourages corrupt practices. It does not consider the element of risk. Sometimes the time value of money is not reflected in the profit maximization objective. It attracts cutthroat competition. Huge profit attracts government interventions. It invites problem for the workers. It affects the long-term liquidity of a company. So the point against the profit maximization are much more than in the favor. Now, because of the limitations of the profit maximization objective, the wealth maximization came into the picture. The goal of the finance function is to maximize the wealth of the owners for whom the firm is being carried on. So, the wealth of the corporate owners is measured by the share prices of the share, which in turn is based on the timing of the return, cash flow, and the risk involved. While taking decisions, only that action that is expected to increase the share price should be taken. It considers the time value of money on the investment decision, the risk of uncertainty of future earnings, and the effect of dividend policy on the market price of the share. So the points of the in favor of the wealth maximization, that it is a clear term. Also, the net effect of investment and benefits can be measured clearly. It considers the time value of money, which is the main advantage of this wealth maximization objective. It should be accepted universally. It guides the management in framing a consistent strong dividend policy to reach maximum return to the equity holders. Now, there are some points which are against with the wealth maximization. First, this concept is useful for the equity shareholders and not for the debenture holders or the bond holders. The expectation of the workers, consumer, and various interest groups create a greater influence that must represent to achieve long-run wealth maximization and also for their survival. But in reality or in practical and in nowadays, we follow the wealth maximization objective as compared to the profit maximization. Now let us discuss the difference between the profit maximization and wealth maximization. The main objective of the wealth maximization is for the long-term growth and it creates value over the time. Whereas for the short profit maximization, the main objective is the short-term growth. Time frame involved in the wealth maximization is the entire life of the company, whereas profit maximization includes the immediate gains. Wealth maximization scope is among all the stakeholders and the societal impact, whereas for the profit maximization, the major benefits are for the shareholders only. So, in all, we consider wealth maximization superior to the profit maximization objective. Key decisions of the financial management. In financial management, three important decisions are taken by the financial manager. The first is the investment decision, second is the financing decision, and the third is the dividend decision. Investment decisions are the decisions related to the assets or the investments. Financing decisions are the decisions related to the capital structure of the company. Dividend decisions are the decisions related to the profit distribution, whether they should be distributed to the shareholders or remain with the company for the future profits or for the future growth. Investment decisions includes capital budgeting decisions, working capital management, and the financing decision includes the cost of capital, capital structure decisions, and the leverage decisions. Dividend decisions include dividend policy and the retained earnings. We will discuss these decisions in detail. Investment decision. As the name suggests, these decisions are related to the investment opportunities to the company. The financial manager has to take a decision regarding the selection of the asset, whether he should choose the long-term asset or a short-term asset, or how much money to be invested in a particular asset. While long-term investment decisions is known as the capital budgeting decisions and the short-term investment decisions are known as the working capital management decisions. So all the decisions related to the investment, whether we should invest in a particular project or not to invest in a particular project or how much money to be invested, are all decisions will be covered under the investment decisions. Financing decisions. As the name suggests, these decisions are related to the finance. So the firm's financing decisions are related to the capital structure of the company, that is, the proportion of the debt and the equity capital in the business. The decisions are made in the light of the cost of capital, the risk factor involved in a particular capital structure, and the returns to the shareholders. So in these decisions, we have to decide whether we should go for a debt or the equity and how much risk is involved in each kind of the capital structure. Now the dividend decisions. As the name suggests, dividend decisions of the firm reflects the distribution of the profit among the owners, whether we should distribute the profit or we should retain it for the future investment. These decisions will be based on the certain factors such as the shareholders' preference, future expansion opportunities, and investment opportunities for the firm. If a firm finds the better expansion opportunities, it will try to distribute less to the shareholders in the form of dividend and keep the major amount of profit in the forms of the retained earnings. On the other hand, if there are no investment opportunities or growth opportunities to the business firm, then it will try to distribute the profits to the shareholders in terms of the dividend. Now, how much dividend they should distribute it, that is, all decisions are related or come under the dividend decisions. Finance manager is an important part of the business firm. With his professional experience, expertise, knowledge, competence, he has to play a key role in an optimum utilization of financial resources to the organization. As the firm size increases, degree of specialization of finance function also increases. In large undertakings, the finance manager is a top management executive who participates in a various decision-making function. His decision is important to an organization. If he takes the right decision, the company will grow in the future. So, he determines the financial need. It is the important function of the finance manager so that it ensures the availability of the adequate financing. Financial needs have to be assessed for the different purposes. Money may be required for the initial promotion expenses, fixed capital and working capital needs. Promotional expenses includes expenses incurred in the process of the company formation. It determines the sources of the funds. That is, he has to choose the sources of the funds. He may issue different type of securities and debentures and may borrow from a number of financial institutions and from the public. The finance manager must definitely know what he is doing, work out strategies to ensure the good finance health of the firm. Next, he also analyzes the financial statements of the firm, which helps in the evaluation and interpretation of the firm's financial positions and operations and involves a comparison and interpretation of the accounting data. A finance manager has to interpret different statements. Next, he has to decide the optimal capital structure so that the maximum return on investment and the liabilities carrying fixed charges has to be defined. Also, the popularly known as CVP relationship, which is known as the cost volume profit analysis for the purpose of the fixed cost and variable and the semi-variable cost, has to be analyzed by the finance manager. Next, for the profit planning and control, he must assume great importance in the financial activities of the modern business. Profit planning ensures the attainment of the stability and growth. The break-even analysis and the cost volume profit it analysis are important tools in profit planning and control of the firms. Next, fixed assets management. A firm's fixed assets are the land, building, machinery, equipment, furniture, and such are intangible assets such as the patents, copyrights, and goodwill. These fixed assets are justified to the extent of the utility or their production capacity. The financial manager also play an important role in the capital budgeting decisions, that is the decisions relating to the long-term planning for the investments and the methods of financing the approved project. It includes the method of mobilization of long-term funds and their deployment in profit project. Capital budgeting is considered as the process of making investment decision on the capital expenditure. It also takes decisions related to the dividend and the acquisition and the mergers. Sources of finance. Sources of finance includes the long-term finance and the short-term finance. Long-term finance are the finance which provides the money for the investment in the form of the fixed assets and also in the form of the working capital needs for day-to-day operations. It includes the external sources and the internal sources. Under the external sources, it includes owned capital, whether in the form of preference capital or the equity capital, debentures, public deposits, lease financing, hire purchase, institutional assistance, government subsidies, mortgage bonds, venture capital. And in internal sources, it includes retained earnings and the provision for depreciation. For short-term sources, it includes loan from the commercial banks, public deposits, trade credit, discounting bills of exchange, factoring, bank overdraft, cash credit, advances from customers, accrual accounts. We will discuss all the sources of finance in detail in the next video. Thank you. I hope the topic is clear to you.